Hey, it's Richard of Matthews Wealth Management. We're going to be covering Efficient Frontier today. It's a kind of in-depth addition to what we did before with modern portfolio theory. So what we talked about in modern portfolio theory was asset classes and picking individual holdings, market timing, etc. Now we're going to talk about how the actual asset classes correlate with each other and how to build a portfolio based on the statistical information. So blah, 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 right? Let's just get into it and I'll show you what it all means and what the term efficient frontier means and how we can best use that when developing and managing portfolios. So the first thing you notice here, we've got some color on the board today. That's exciting. I've got bonds in red. I've got equity or stocks in blue. I've got the international stock holdings there in that purple color. And then we've got some greens in there, and we'll kind of go through those, each holding here, just to kind of relate what this means on this graph. So first thing that makes the most sense is cash. We've got this green dot there, and what that signifies is, first of all, we're looking at a mean rate of return, and we're also looking at a standard deviation in terms of plus or minus. So think of this as reward and this as risk. So the further we go to the right, the higher the risk. The higher up we go, the more return, right? Makes sense. So cash is considered riskless in terms of U.S. sovereign currency, if we want to go there. But so cash makes the most sense. On the flip side, emerging markets, startup companies, small cap growths, those are the riskiest. Those make a lot of sense. So what we're talking about is as we increase our risk, we should expect to increase our return. Now, the information here that we've used dates back for the equities to 1926. So this is a very long-term mean or average return for each of the equity holdings. All of the debt dates back to 1970, and that's Ibbotson Associates is who compiles and keeps this going. So this is up to date with very long-term averages, right? So as we're building out portfolios, obviously where we are today in 2020 is a very different world than what we saw back in, let's say, 1978 or 1929 even. So what we want to do is take what the long-term picture looks like with the ups and downs and build a portfolio that's going to stand the test of time, right? Because if we're investing for retirement, we need to make sure we're looking at a long-term time horizon as far as how to compile this. If we just build a portfolio on what last year did, it's pretty much going to be a train wreck. So we want to have something that has a lot of data points, a good average here. So what we notice first is short-term bonds. Makes sense, is the next one in terms of risk. Short-term bonds have a very short time frame of exposure to risk. Then we have intermediate term. Long-term comes all the way out here. Municipal bonds, treasury inflation protected securities, international bonds, high yield bonds, emerging market bonds. That makes sense. So when we're going through our market updates each month and we're talking about these asset classes, we can always come back and compare, well, how does it compare to the long-term average? And this looks very, very different than what our most recent market update was looking like. And we don't typically cover emerging market bonds or international bonds in our market updates, but that's where those asset classes lie on the long term. But it makes sense for our bonds to be lower returns than our stocks, but also much safer, much more predictable. So let's jump to the stock. What we have first is large cap value. What's interesting in the long term, looking back to 1926, is how poorly growth has done. So if we're just going to compare large cap value and large cap growth, what this means is that we're taking higher risk in large cap growth historically and making less return. So that's exactly the opposite. This is traditionally why most retirement planners or portfolio managers have a heavier concentration in large cap value. It's the best of both worlds. It's lower risk and higher return, right? So if we were to do like a little graph here, this would be in the top left quadrant if we put that right on the center point. So that's why we have a higher concentration in the traditional asset allocation of large cap value versus large cap growth. You see that repeat also in mid-cap value, mid-cap growth. In fact, it's substantially higher risk for less return. So that's another interesting one. Same thing on small cap value, small cap growth. So normally in an asset allocation, we would have more allocated towards the value side, not just because it's safer, But what that means in the long run is sometimes safer is a higher return. You don't take those losses and have to dig back out of the hole. So that's kind of to cover the U.S. equity market on how those work. International is lower return, lower risk than emerging markets. That makes sense, right? That's what we would expect for like a German company versus a Indonesia company. So that covers all of that. Real estate comes in the middle here, as well as commodities. All right. So now let's talk about, now that we see all of this, what do we do with it, right? Like, how do you build a portfolio out of rate of return and risk, right? That's kind of what we're doing. So if you followed these videos, or if you're a client at Matthews Wealth Management, you know that we follow targeting a rate of return and then building a portfolio with the lowest amount of risk to get us there. So what that means is, let's say I've put in moderate and moderate aggressive here. Just those are terms that everybody relates to, because the brokers and everybody else ask those risk tolerance questions, and it's up to you to know how much you need to be risking, apparently. But what we would say with that is, if we want to have one of these volatility numbers, so this is like a 9.05 is actually what we've got for moderate, and a 10.51 for the moderate aggressive. These are targeting two different rates of return, right? So if we need to hit a certain rate of return, depending on where we want to be along this efficient frontier, that's going to dictate what percentage of our portfolio needs to be allocated into each of these asset classes. So what we're doing is we're just doing a big average of averages. Now, what the efficient frontier technically signifies, it's a hypothetical line, right? This doesn't actually exist. The theory states that you cannot be more efficient than this line. So if you were to, say, come across something that was Bitcoin up in here, I don't know, I'm making that up. At one point, it was a fad enough to where, oh, there's no risk. Everybody's just bidding that price up and you're making big returns, right? But it's a theoretical line that says nothing should exist out there, and especially for the long term. So what our goal is to find the right mix of all of these asset classes and have that average move as close to this line as possible, okay? So the closer we get to it, the more efficient our portfolio is with risk and reward. So what I've got here is just kind of a centroid of a hypothetical portfolio that, say a client comes in, they've got a 401k that's been, put into the pie chart based on what their HR rep told them to do. And so this is what we find is their volatility or standard deviation, and 5 point whatever that percent is on the rate of return. So historically speaking, this is pretty far from our efficient frontier. What we want to do is find a way to get closer. So there are two ways that we can get closer. The first thing is, if we are comfortable taking on this level of volatility up and down, then we should be able to make more with it. We should be able to get a higher return. On the flip side of it, if we're happy making our 5.5% or whatever that is, then what it means is that we should significantly be able to lower our risk, right? So what we actually end up usually doing is something in the middle, coming back on the risk and moving up on the rate of return. So we just saw that on large cap value, large cap growth, mid cap value, mid cap growth, small cap value, small cap growth. You're lowering the risk and increasing the rate of return. And that's why when we plot this, where somebody's portfolio is, we then can see how efficient it actually is. And so the closer you are to the line, the higher your alpha. So if you've tracked all of our statistics before, alpha is a measure of efficiency, right? So the higher the alpha, the closer to the line we are. So I went ahead and put two moderate and moderate aggressive portfolios up here and showed you the weightings. So if we wanted to actually have this portfolio that's moderate, that's generating since 1926 or 1970, a 5% tax-adjusted rate of return with a plus or minus of 9.05, we would have 7.73% of our money in large cap growth. We'd have 11.41 in large cap value. Mid cap growth and mid cap value would both be 5.22, blah, 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 right? So this is not rocket science. Really, the idea is to find out what is our rate of return, how close can we get to this curve, meaning keeping our volatility down, and then these numbers just spit out of machines. I mean, it's literally just averages. There's not a ton of math to this. Now, once we have our 7.73% in our large cap growth asset class, the next step is, okay, well, what exactly do you need to buy in large cap growth? Are we doing ETFs? Are we just buying, like Apple lately, or Walmart, or what is it that we're actually targeting in large cap growth with our 7.73? So there's an additional layer of expertise and research that goes into what do we buy, but just building the portfolio is pretty straightforward. I mean, this isn't very advanced math. This is just averages and multiplication. So if we jump to moderate aggressive, just to kind of go through the differences there, we're going to step up, obviously, the volatility. We're also stepping up the return. So with all of these inputs, it means we increase our growth, we increase our value, pretty much increase all of our equity. Small cap growth dropped a little bit. International grew by about 3%, increased emerging markets. Now we start shrinking our bonds. So it makes sense, right? The more risky we are, the more we're going to have in equities, the fewer we're going to have in bonds, and that shifts us away from this red, more towards this green, purple, and blue, right? So pretty straightforward stuff. This isn't rocket science, but yeah, if you want to see where yours is on an efficient frontier, I mean, this is the first thing we do when we sit down with clients. We find out, well, where are you? What is the opportunity? How are we invested in terms of our percentages? Does that make sense on an efficient frontier model? And all these come in reports. We use Morningstar research, but this is what we do. If you have questions and you want to sit down and see where you fall, feel free to give us a call. But yeah, this is the efficient frontier. I hope you enjoyed it.